Everyone's been buzzing about the Federal Reserve cutting interest rates, but here's the real question. Will that change the housing market here in the Bay Area? Will it finally make homes more affordable? Or will it actually fuel more competition? Before we begin though, what's crazy is that 90% of you watching here are not subscribed. Gotta change that right now, so be sure to hit that subscribe button. I'm Spencer Su, I lead a Bay Area real estate team, and we've helped over 350 families with their moves in the last 7 years. And today, I want to break this down for you. Not just the headlines, but what it really means for buyers, sellers, and especially homeowners who are thinking about moving up into the next property. Because believe it or not, they're the ones who stand to benefit the most from this potential change. I've seen firsthand how even small interest rate moves can create major shifts in our market. Just look at what has happened a couple of years ago. Let's get into it. Now, when people hear rate cut, a lot of them think that the mortgage rate is instantly going to drop. But that's not quite how it works. The Federal Reserve sets what's called the federal funds rate. That's the rate banks charge each other for overnight loans. It doesn't directly set mortgage rates, but it does influence them. But more importantly, its question is about investor sentiment in the bond market. Look at the 10-year treasury yields. So when the Fed cuts rates, it does signal that borrowing money is going to be cheaper across the board. Now, over time, though, mortgage rates tend to follow that direction. Sometimes they move in anticipation, sometimes they lag behind. But the takeaway is simple. A rate cut is the Fed's way of easing, and this does generally create downward pressure on rates. So let's talk about buyers. For first-time buyers, a small drop in rates is helpful, but it doesn't actually completely solve the affordability challenge. Think about it. For a $1 million loan, a 0.5% drop might only mean a few $100s a month in savings. That's real money, but it doesn't transform the picture overnight. Where it gets really interesting, though, is for move-up buyers. People who already own a home and are thinking about upgrading. Why? Because these are the homeowners that are the ones that are stuck, that feel stuck. Maybe they bought their home at a sub 3% rate, and right now the rates have been hovering in the 5 to 6 range. Selling that home and buying a bigger one means giving up their lower monthly payment for something much higher. That's a huge barrier to some. But when rates move down even by a point, the gap will shrink. That's when the math begins to make sense for a lot of these families. Now, here's what I want you to really consider though. This is actually more of a mental block than a true affordability block. Yes, rates are going to be higher than they were in 2020 or 2021. But then again, those are historically low, once in a lifetime numbers. We may never see those rates ever again. Yet homeowners still comparing today's rates with those record lows are really just dreaming. Because that comparison alone makes moving feel impossible. But if you really zoom out and look at what was the average mortgage rate over decades, this range is actually fairly normal. The real question isn't, are rates as low as they were at the bottom? The question is, do these numbers work for my family and my future goals right now relative to my income and my savings? Because here's the kicker. Most homeowners in the Bay Area aren't just relying on salary income. They have significant equity in their current home. They also have the stock market gains, restricted stock units of RSUs, and or gifts and savings from their family and parents. With how strong the market has been over the last several years when it comes to the stock market, many people actually have more resources to deploy today than they did in the past. This means the barrier to moving up is as much about the mindset than it is about pure math. So you should ask yourself this: what if you just do nothing? If you stay in your current home, you're going to obviously keep saving. You might also continue building equity if the market keeps climbing. Meanwhile, your general stock portfolio is likely going to grow too, given how well the markets have been performing. And I'm not saying that's a bad place to be, but here's the challenge. Money in the bank or in the money in the market doesn't get you the home, the lifestyle, or the location you may actually want. And if you wait too long, a few things may happen. Prices could creep up while you sit on the sidelines, not even monitoring it. What happens when rates do drop further? Competition spikes. You see the same situation. The economy slowed down, rates dropped, and then all of a sudden buyer demand picked up, even without COVID. Because when rates do drop further, competition spikes. And suddenly you're finding yourself in multiple offer situations again, which is extremely mentally draining. I personally help the client every single week for the last 7 years, so I know the toll it takes on people. Now, if you look at the reverse, you keep saving, but you ultimately miss years of actually living in a home that actually fits your family's needs. At the end of the day, it is less about timing the perfect rate and more about deciding when and where you want to spend your money. You're already going to be paying for housing. The question is whether that payment is helping you build the future you want or just keeping you in place because of a psychological anchor to the past, which is the rate being so locked in your head. Now, let's talk specifically about the Bay Area. Unlike many other markets in the country, demand here is generally still strong. Now, we do have this rare window right now that many others are scared, but doesn't mean things are tanking. Smart buyers are using this chance to move on with their goals, and many of them are actually keeping their previous home to just convert them to rentals since the rental market is so hot. What do you think all those would-be buyers would be doing? They're usually just renting. So here's the reality. When rates do come down, and I hope it does for sure, it doesn't just make homes more affordable. It actually feels more competition usually, because the number of homes for sale is generally so limited, especially in good areas and for single family. So even a small increase in buyer demand can push prices significantly higher. That's why the smart buyers are making it work now, and rates drop, just simply refinance. That's why the timing is so critical. Waiting for that perfect rate may not actually save you money, because by the time that happens, or by the time you realize it, home prices may have already adjusted a certain direction. So, will the Fed's rate cut and continued rate cut change the housing market? It's not going to solve affordability overnight, but it will open up the door for move-up buyers who've been waiting on the sidelines. And of course, those that are renting to finally get them over the fence. Now, as those homeowners start to list and buy, it will unlock more inventory, hopefully, that they're not just renting it out, and fueling demand, which sets off a chain reaction across the market. And remember, a lot of this does come down to the mindset. Just do the math relative to your income and your savings. Because with equity, savings, and stock market gains, many homeowners are actually more equipped to make the move now than they was before. The question is whether they'll let that mental block of a 5-6% rate that has been in the place for the last 3 years keep them frozen in place, or will people take advantage of the opportunities in front of them? So if you're a homeowner in the Bay Area who's been thinking about selling and upgrading, this could be the moment where the numbers actually will be in your favor and it's less stressful. My team and I specialize in helping clients navigate exactly these transitions, maximizing the equity you built, timing your move strategically, and making sure you don't just buy or sell, but make the smartest financial decision for your family. So if you like a custom plan tailored to your situation that's data-driven, reach out to me directly at 408-547-4590. Let's talk about your options and how you can take advantage of this new environment before the rest of the market catches on.